Hello and welcome back to our channel. Today, we're diving into an investment vehicle that's often overlooked but has the potential to be incredibly lucrative. We're talking about real estate investment trusts or REITs. Now, let's explore the fascinating world of REITs. Let's start with the basics. What is a REIT? REIT is short for Real Estate Investment Trust. Imagine a company that owns, operates, or finances income-generating real estate, and then allows investors like you and me to buy shares in their property portfolios. That's essentially what a REIT is. The REIT model is quite fascinating. These companies work by pooling money from many investors to buy and manage a diversified portfolio of real estate. This can range from office buildings, apartments, warehouses, hospitals, shopping centers, hotels, and even data centers. So, you may be wondering, how do you invest in a REIT? The process is simpler than you might think. REITs are publicly traded, meaning their shares are available on major stock exchanges. You can buy and sell shares of a REIT just like you would with stocks of any other publicly traded company. There are a few different types of REITs out there. First on our list are equity REITs. These companies own and manage income-producing real estate. Profits are primarily generated through rents from their properties. The range of property types is broad, from shopping malls and office buildings to apartments, hotels, and even hospitals. Next up are mortgage REITs. They provide financing for real estate by purchasing or originating mortgages and mortgage-backed securities. They earn income from the interest on these investments. Keep in mind that these REITs tend to be more sensitive to interest rate changes. Lastly, we have hybrid REITs, which combine the investment strategies of equity REITs and mortgage REITs. They both own properties and hold mortgages. As a result, they provide a mix of rent and interest income. Additionally, there are specialty REITs that focus on specific sectors. These can include sectors like healthcare, retail, residential, industrial, and even data centers. Investing in these REITs can be a strategic way to tap into certain market sectors. Let's move on to some of the advantages of investing in REITs. One of the most attractive aspects of investing in REITs is the potential for dividend income. REITs are required to pay out at least 90% of their taxable income as dividends to shareholders. This can make REITs a great option for income-focused investors. Next up is liquidity. Unlike physical real estate, which can take months to sell, shares in a REIT can be bought or sold on the stock exchange at any time during trading hours, offering investors greater flexibility. REITs can also offer diversification benefits. Investing in REITs allows you to gain exposure to the real estate sector, which can provide a counterbalance to other equity investments. Additionally, there are different types of REITs, including equity, mortgage, and hybrid REITs, each offering unique exposure within the real estate market. Another major advantage of REITs is their accessibility. REITs can be bought or sold like any other stock, regardless of the share price. This means you can start investing in real estate with a relatively small amount of money. But as with all investments, REITs come with some disadvantages. Firstly, one significant disadvantage of investing in REITs is the exposure to property market volatility. The value of REITs is directly linked to the value of the properties they own. Therefore, if there's a downturn in the property market, the value of your REIT investment could take a hit. Next, let's talk about interest rate sensitivity. REITs tend to be more sensitive to interest rate fluctuations than other types of stocks. When interest rates rise, the cost of borrowing increases, which can reduce the profitability of REITs and lead to a decrease in share prices. Also, consider the high payout ratio. Because REITs are required to distribute a large percentage of their income as dividends, they often have less retained earnings for growth. This can result in slower growth rates compared to other types of companies. Finally, tax considerations. While dividends can be a great source of income, it's important to note that they are generally taxed as ordinary income. This can result in a higher tax burden compared to the lower capital gains tax rate on other types of stocks. That wraps up our exploration of real estate investment trusts. They can be a powerful tool in diversifying your portfolio, but as always, it's important to conduct thorough research and consider your financial goals before making any investment decisions. If you found this video helpful, give it a thumbs up, share it with your friends, and subscribe for more content like this. Until next time, happy investing!